Every major stock market crash in history had one thing in common. It left warning signs weeks, months, sometimes even years before the market finally collapsed. The problem? Most investors only recognize those signs after they've already lost money. Today, we'll uncover the hidden patterns that have appeared before nearly every major market crash. Not to predict the next one, but to understand what history has been trying to teach investors all along. So let's start with one simple question. If the warning signs were there, why did almost nobody see them? I'm Gavin, and today we're uncovering the hidden patterns that history has revealed before nearly every major stock market crash. Why crashes are rarely random. If you've ever watched a market crash unfold, it can feel almost instantaneous. One day investors are celebrating record highs. The next headlines are filled with panic. Billions of dollars have disappeared, and everyone is asking the same question. What just happened? But here's what history reveals. Stock market crashes rarely begin on the day the market falls. They begin long before anyone notices. The warning signs don't appear in a single dramatic moment. They build quietly, one piece at a time. Valuations become stretched. Speculation replaces discipline. Investors grow convinced that prices can only move in one direction, and with every new record high, confidence grows stronger. That's what makes market bubbles so dangerous. They don't feel dangerous, they feel exciting. In 1929, investors believed America had entered a new era of permanent prosperity. In the late 1990s, many believed the internet had rewritten the rules of investing. Before the 2008 financial crisis, millions were convinced that housing prices could never fall nationwide. The stories were different, but the psychology was almost identical. Every generation finds a reason to believe. This time is different, and that's why so many investors miss the warning signs, because those signs are usually hidden beneath optimism. When markets are climbing, good news gets all the attention. Rising prices reinforce confidence. Success attracts more buyers, and the cycle feeds itself, until eventually, the market reaches a point where expectations become impossible to satisfy. That's when even a small disappointment can trigger a much larger reaction. So if crashes aren't random, what are the warning signs that history keeps repeating? Let's begin with the first, and perhaps the most important one of all. When stock prices become disconnected from reality. Hidden sign number 1. When prices become detached from reality, imagine someone offers you a house worth $500,000. The next day, another buyer offers $800,000. A week later, someone is willing to pay $1.2 million. Has the house become more valuable in just 7 days? Probably not. The only thing that's changed is what people are willing to pay. That's exactly how financial bubbles begin. In the stock market, prices don't always rise because businesses become dramatically better. Sometimes, they rise because investors become dramatically more optimistic. For a while, that optimism seems completely justified. Companies report strong earnings. The economy looks healthy. Headlines celebrate new all-time highs, and every new record convinces more people that prices will keep rising. But eventually, the price of owning a business starts growing much faster than the business itself. That's when investors stop paying for today's profits and begin paying for tomorrow's dreams. Financial economists call this overvaluation. One of the most widely respected ways to measure it is the cyclically adjusted price-to-earnings ratio, better known as the CAPE ratio. Developed by Nobel Prize-winning economist Robert Shiller, the CAPE ratio compares stock prices with a company's average inflation-adjusted earnings over the previous 10 years. Why 10 years? Because businesses naturally go through good years and bad years. Looking across an entire decade filters out much of that short-term noise, making it easier to judge whether the market has become unusually expensive. And history reveals something remarkable. Before the Wall Street crash of 1929, stock prices had climbed far faster than corporate earnings. 70 years later, during the dot-com bubble, Investors once again believed a new era had arrived. Technology companies with little revenue, and in some cases no profits at all, were valued at billions of dollars. By December 1999, the CAPE ratio had reached around 44, the highest level ever recorded at the time. Within the next few years, the Nasdaq Composite lost nearly 78% of its value. The internet went on to transform the world, but the stock prices had raced far ahead of business reality. That's an important distinction. The technology wasn't the problem. The valuations were. History teaches the same lesson again and again. High valuations don't cause market crashes by themselves. Markets can remain expensive for months, sometimes even years. But when investors begin paying extraordinary prices while expecting perfect outcomes, the margin for error becomes incredibly small. A disappointing earnings report, an unexpected economic slowdown, or a shift in investor confidence can suddenly change everything. Because when expectations have become unrealistically high, even good news may no longer be good enough. That's why extreme valuations have appeared before many of history's biggest market declines. Not as a countdown clock, but as an early warning that optimism may be running ahead of reality. But if these warning signs are visible, why do millions of intelligent investors continue buying anyway? The answer isn't found in financial statements, it's found in human psychology. Hidden sign number 2. When greed overpowers logic. If the warning signs are already there, why don't investors simply stop buying? Because markets aren't driven by numbers alone. They're driven by people. And people are emotional. At the beginning of every bull market, investors buy because they see value. But as prices continue to rise, something begins to change. People stop asking, is this investment worth the price? And start asking, what if I miss out? That's the moment psychology takes control. It's called FOMO, the fear of missing out. And throughout history, it has fueled nearly every major market bubble. We've seen it before. In the late 1920s, many Americans borrowed heavily to buy stocks, convinced the market would keep climbing. During the dot-com bubble, investors poured money into internet companies that had little revenue, and in many cases no profits at all. More recently, we've seen similar behavior surrounding meme stocks, cryptocurrencies, and certain AI-related companies. Different assets, different technologies, but the same human behavior. When prices rise quickly, success creates confidence. Confidence attracts attention. Attention attracts new buyers. And those new buyers push prices even higher. It's a cycle that feeds itself. Eventually, the excitement becomes so strong that many investors stop asking whether an investment is worth the price, and start believing the price will justify itself. History has a name for this mindset. This time is different. It's one of the most dangerous phrases in investing, because every generation believes the old rules no longer apply. That technology has changed everything, that the economy has entered a new era, or that markets have become too sophisticated for another major crash. Yet history tells a different story. The technology changes. The companies change. Even the reasons people become optimistic change. But human psychology barely changes at all. That's why market bubbles keep returning. Not because history repeats itself perfectly, but because human behavior does. Yet psychology alone isn't enough to trigger a market crash. The biggest declines often begin when something else starts changing beneath the surface. Something most investors never notice. The flow of money itself. Hidden sign number 3. When the foundation begins to crack by the time a market crash reaches the headlines. Professional investors have often been watching warning signs for months. Because while most people focus on stock prices, institutional investors watch the economy beneath them. One of the clearest places to look is the bond market. It rarely grabs headlines, but it's where governments, banks, pension funds, and other large institutions invest trillions of dollars. One signal they watch closely is the yield curve. Normally, long-term bonds offer higher yields than short-term bonds, but occasionally, that relationship reverses. Short-term yields rise above long-term yields. This is known as an inverted yield curve. Why does it matter? Because it suggests investors expect slower economic growth ahead. It isn't a crystal ball, and it can't predict exactly when a market will fall. But historically, an inverted yield curve has preceded every U.S. recession since the 1950s, although the timing has varied. Professional investors also monitor credit markets, corporate debt, liquidity, and insider activity. None of these signals guarantees a crash. But when several begin flashing at once, history suggests that risk is quietly building beneath the surface. And that leads to another pattern that has appeared before several major market downturns. When too much of the market's success depends on too few companies. Hidden sign number 4. When too few companies drive the market, there's one final warning sign that has appeared before several major market downturns. Not falling prices, but a market increasingly driven by just a handful of companies. At first, it looks like a sign of strength. A few exceptional businesses outperform everyone else. Their earnings grow, their stock prices soar, and because they become such a large part of the market, they begin carrying the major indexes almost by themselves. From the outside, everything looks healthy. The S&P 500 keeps reaching new highs, but beneath the surface, the rally is becoming increasingly narrow. History has seen this before. In the early 1970s, investors believed the Nifty 50 were so dominant they could be bought at almost any price. Many were outstanding companies, but even outstanding companies can become overpriced. When the market turned, many of those stocks fell sharply. The same pattern returned during the dot-com bubble. A small group of technology companies attracted most of the money, attention, and optimism. Eventually, their valuations outran reality. Today, market gains have once again become heavily concentrated in a relatively small number of companies. That doesn't mean another crash is inevitable. Many of today's market leaders are highly profitable businesses with strong balance sheets. But history offers an important reminder. When a growing share of the market depends on fewer companies, the market becomes less resilient. If those leaders begin to struggle, the entire index can feel the impact. That's why record highs don't always tell the whole story. Sometimes, the market is stronger than it appears. Other times, it's simply standing on a narrower foundation than most investors realize. And when you combine narrow leadership with stretched valuations and rising optimism, the warning signs become much harder to ignore. But here's the mistake many investors make next. They start trying to predict the exact day the market will crash. The biggest mistake investors keep making after seeing all these warning signs. It's tempting to ask one question. So, when is the next crash? But that's also where many investors make their biggest mistake. They believe the goal is to predict the exact day the market will fall. History tells a different story. The world's greatest investors didn't build their fortunes by accurately predicting every crash. Because the truth is, nobody knows exactly when the market will turn. Not economists, not Wall Street analysts, not even the most successful investors. Markets can remain expensive longer than most people expect. Optimism can last for years, and even when warning signs are flashing, prices can continue rising. That's why trying to time the market is often just as risky as ignoring the warning signs altogether. Instead, experienced investors focus on what they can actually control. Preparation. They understand that market crashes aren't rare exceptions. They're a recurring part of investing. Painful, unpredictable, but inevitable over the long run. Rather than asking, "How do I avoid every crash?" they ask a different question. Am I prepared if one happens tomorrow? Warren Buffett once remarked that you only discover who's been swimming naked when the tide goes out. A market crash does exactly that. It exposes excessive risk, weak businesses, and investors who are relying on endless optimism. History has repeatedly shown that every major bear market has eventually been followed by a recovery. The investors who panic often lock in their losses. Those who remain disciplined are usually the ones who benefit when confidence returns. That's the real purpose of these warning signs, not to predict the next crash, but to recognize when risk is quietly building. Because history has one final lesson. Markets evolve. Technology evolves. Entire industries rise and fall. But human nature barely changes. And as long as fear and greed continue to drive financial markets, the warning signs will keep returning. The only question is, will you recognize them before everyone else does? The next stock market crash probably won't look like the last one. It may begin in a different industry, a different country, or for a reason nobody expects. But if history has taught us anything, it's that crashes rarely happen without warning. The warning signs simply wear different faces. Valuations become stretched. Optimism turns into overconfidence. Risk quietly builds beneath the surface. And by the time panic reaches the headlines, the market has often been changing for months. That's why the most successful investors don't spend their lives trying to predict the next crash. They study history instead, not because history tells us exactly what will happen, but because it reveals how markets and people behave when optimism reaches its limits. Every generation believes its boom is different. Yet from 1929 to the dot-com bubble, to the 2008 financial crisis, the pattern has remained remarkably consistent. The catalyst changes, the companies change, the technology changes, but fear and greed never do. And that's the real lesson behind every market crash. The warning signs aren't there to tell us when the market will fall. They're there to remind us that no bull market lasts forever, and no bear market lasts forever either. Markets have recovered from every major downturn in modern history. Not overnight, not without pain, but they have recovered. Which means the investors who benefit the most aren't the ones who can predict the future. They're the ones who understand history, respect risk, and stay disciplined when everyone else loses perspective. Because in the end, the biggest advantage in investing isn't knowing what's going to happen next. It's recognizing the patterns that have been repeating for more than a century. If you enjoyed this documentary and want to better understand how money, markets, and the financial system really work, consider subscribing. Thanks for watching, and I'll see you in the next one.